Hello and welcome to Policybazaar. I'm Arjun Bhagat. Now, term insurance is a fairly simple concept. When you buy it, you promise to pay a certain amount of money to an insurance company in return for the financial protection of your loved ones in the event of your unfortunate death. But how does one determine if the amount of insurance required is adequate? Does everyone need it? At what age should one buy it? How do we calculate it? A lot of questions there. So we've got Yashish Dhaya to answer them for us, CEO of Policybazaar and also his founder. Welcome to the show, Yashish. We understand the broad concept of insurance, but what is the correlation of insurance and age, and what is the right amount of insurance to take?
See, essentially what you are insuring against is the fact that the person who was earning a particular amount of income or was bringing a particular amount of economic value to the other dependents would not be there, and hence their income would not be there. And that is essentially what one is trying to insure against. So if there's an individual who's, let's say, got a 1 lakh rupee income and they are 35 years old, and one can clearly see they've got a progressive career, which implies that maybe in about 7 years' time, this 1 lakh will go to 2 lakhs. Essentially what you're doing is trying to say, if they were not there, what kind of financial quantum would be required? What kind of financial amount would be required to replace that earning stream? All the way from when they are 25, look, this individual is going to keep working till they're about 65. Post 65, they may even have a pension. And so what kind of amount would be required to kind of address all of that so that his spouse, his family, his dependents can continue to, live a normal life?
So what you're basically saying is you're talking about HLV, which is human life value. So
economically, yes.
Economically, yes. So explain that concept for us, and how do you actually determine that for a family?
Okay, so it's got to be done not just through a very simple formula, but everybody has to be looked at slightly differently. Let us say it is the primary earning member. The primary earning member's pretty much entire income is required for the household. That is how the household runs, minus his or her own expenses. So, for example, as we spoke about that particular case, when you're taking the 25-year-old person or 35-year-old person who's earning, let's say, 1 lakh rupees a month, and you can project outwards that in about 7 years' time, they may be earning about 2 lakhs, another 15, 20 years' time, they may be earning about 4 lakhs, and, they will work for the next 25 to 30 years of their life. So, a certain amount of money is calculated. Now, you can look at an annual income. The simple way to do it is take the annual income and divide it by the current interest rates available. That's one very rudimentary way of doing it.
And what about inflation then?
So then, basically your principal hopefully will take care of the inflation part, and right. You don't earn just the interest on it. So let's say today, by investing in any bank deposit, you can earn about 8%. You got to also project that returns will come down. You can earn about 8%. So if a person has, let's say, 1 lakh rupees a month, and that implies about 12 lakh rupees a year, and you do it on the gross. You divide it by 8%, you will end up at about 100. So another rule of thumb is about 100 times monthly income, monthly gross income. So about 100 times monthly gross income. Remember, you will get this money tax-free. So that implies there is some about 50% inflation already built into the future. It is a rule of thumb. So typically what any individual would do is take this at about 28, 29 when they start having dependents. But in the next 10 years, as their income increases, they probably require another cover because their human life value would have increased. But as they start getting older, when there are only 10 years to go before they retire, they may start looking at mechanisms by which the value of the term cover starts coming down. So, they can get out of one of the covers. So that is broadly how you would calculate it. Roughly, monthly income times 100. However, how do you calculate the human life value from an economic perspective of the spouse? Because if the spouse is not there, while the spouse may not have income, suppose a non-earning spouse, there is still going to be a financial impact on the family. And right. Those are impacts that can be, again, the broad rule of thumb is about half of the primary earning member's human life value is also the non-earning member's economic human life value. I again say economic because I find the concept of just calling it human life value slightly odd because humans are not just valued for their economic value. But yeah, economically that's the value of the individual, about 50%. So whatever the primary earning member's salary is, gross salary, multiplied by about 50. And that would be the impact of not having the spouse. Now, there are other mechanisms available. So you can look at it from a cost perspective. So you could see it from a perspective of, okay, if the earning is not there, what are the costs of this family going to be and for how long? And you could essentially...
It seems a little complicated though, isn't it?
That's why the
how
rule
does
of
one
thumb,
need to look at it? Yeah.
So the rule of thumb is before the age of 45, roughly about 100 times monthly income. For the non-earning spouse, 50 times monthly income. After the age of 45, it would come down a bit. It will become about 80 times monthly income. And after the age of 50, it will become about 50 times family income. Monthly income.
So, what about the pointers that we need to keep in mind broadly when we calculate this?
Now calculating human life value and calculating the amount of term insurance that you require are two different things. So human life value basically tells you what is the value or the economic value of this individual over their lifetime. However, you may have liabilities which also need to be taken care of. So once you've considered the way you would look at a term cover would be you look at the costs that are going to be there as well as the liabilities that are going to be there. So essentially what you would again do is the same thing. Look at the costs, multiply them about 100. That will take care of both the inflation and the gross costs. Multiply them about 100 to 125, and that should be the amount of term cover you would require plus all the liabilities. The liabilities are home loans, any expense that needs to be taken on. Suppose again the same thing, 35-year-old person, their family cost is let's say 70,000 rupees. Multiplied by 125, that would take you to roughly about 95 lakhs. It'll come to about the same. However, if they have any home loan, let's say they have a 50 lakh rupee home loan, add that in, that becomes 1 crore 45 lakhs. Suppose they assume that when the children grow up, they would require a certain kind of education. Let us say they require 20 lakhs, they've got 2 children and they require 20 lakhs each, but there is 10 years to go. So from a net present value of that 20 lakhs is let's say 10 lakh rupees. So it's 2 sets of 10 lakh rupees. Hence the term cover they would require would be about 1 crore 65 lakhs. So essentially home loan plus any educational or any specific expenses coming out into the family in a period plus regular expenses times 125, because regular expenses will continue and adjusted for inflation will be about 125 times.
All right, so that's how you determine the amount of term cover that you want or the insurance that you need. What about the payment options?
Yes.
Because there are some interesting payment options that have come up as far as, or rather payout options as far as term insurance plans.
See, the interesting part about any insurance product is when you get the money back, it is tax-free. And so whether you get it in a lump sum or whether you get it over a period of time, it is going to be tax-free. Now, for the home loan component, so there are, as I mentioned, there's a home loan component and there's a income component or a cost component of the family. For the home loan component, it makes sense to have a one-time payout. So suppose you got a 50 lakh rupee home loan, it makes sense to have a 50 lakh rupee term cover so that the home loan can be paid off immediately and that liability does not stay on the family. Now imagine if the family's expense is about 70,000 rupees, then having an income based payout mechanism of roughly about 1 lakh rupees is not a bad idea, because some of them can go into savings which can be used for future income, and if this income continues about 20-30 years, the children's cost can be taken care of, etc. So a good balance between a one-time and a regular payout is quite helpful. So a one-time payout would usually be used for loans or liabilities, whereas a regular payout should be used for family expenses. Remember, a regular payout is very important because all of us can get excited about a particular investment opportunity. All of us are not the best financial planners in the world. Look at our own lives. Every decision is not meticulously thought through. So we can end up making wrong investment decisions. And hence, from an insurance perspective, which is specifically for people with children who will have expenses as they grow up, it is very important to have an income support so that their education and other expenses can be taken care of, and the family unfortunately does not end up spending the money they receive through a lump sum on one big purchase or on one instrument that can make a mistake.
So can we talk specifically about some plans which are there as far as deferred payments are concerned?
Yeah, you've got 2 plans out there right now. there is a plan from Aviva called Aviva iSecure, which essentially pays out only in a deferred basis. It pays out for the next 15 years. So whatever, suppose you want 1 lakh rupees for 15 years, you take the, you can take that particular cover. They also have a normal Aviva plan which kind of pays out in one go. So you can take a combination of that. As I said, for loans you could take the one-time payout, and for the deferred amount you can take out a deferred pay plan. You also have a plan from Max Life. Max Life has got 3 options. You can take a one-time lump sum. You can take a lump sum with a deferred pay plan for about 10 years, or you can take a deferred pay plan which is increasing in value. So every year it goes up by a certain percentage. The payout goes up by a certain percentage for the next 10 years. So those are the 2 options that exist. A lot of companies are going to be coming out with these options over the next 6 to 12 months. Almost everybody's applied for a product which has a deferred pay plan because it makes a lot of sense from a consumer point of view.
Right, Yashish, we're going to continue this discussion, also take viewers' questions, but after a short break. But you can write to us at ask.policybazaar.com. You can tweet us at policybazaar_in, and we'll see you shortly after this break. Keep watching. Welcome back to Policy Bazaar. I'm Arjun Bhagat, and with me is Yashish Dhaya. Yashish, we're talking about deferred plans, deferred term plans, and payouts thereof. Are they more expensive?
Deferred plans are actually lower cost than fixed, lump sum pay plans. And the primary reason is, in a lump sum pay plan, you're going to be paid immediately, whereas in a deferred plan, you're going to be paid over the next 10 years or 15 years. So clearly, there is a certain time value of this money. Now, there is, of course, the security benefit that you will receive this money every month for the next 10 years or 15 years. And that is certainly a benefit and security provided to the children. But from a time value perspective, actually comes out to be cheaper from an overall perspective. So both the deferred pay plans are actually amongst the cheapest plans in the market.
Right, so let's do a short recap, because it is a complicated subject, determining how much insurance one needs, and also, correlating it to the human life value.
I'll give some very simple pointers here. You've got 2 approaches. One is the income approach, second is the expense approach. Let's start with the income approach. If you're below 35, 100 times monthly gross income. If you are between 35 to 50, 80 times monthly gross income. If you are above 50, about 50 times monthly gross income. Now, if you take the expense plan, whatever the family expenses at any age, it does not matter, 125 times the family expense, and then add 2 things. One is any liabilities like loans, etc. that you have, and add the net present value, which basically is discount a bit, every 10 years discounted to half, any known expenses which are going to come up, specifically around children education. So 125 times monthly expenses plus home loan plus whatever expense you think is going to be there for the children as they grow up, discounted to half every 10 years. So if there's 10 years to the children's education, half of what do you think the expenses are going to be?
Right, Yashish, it's time to take viewers' questions. We've got Parakram from Assam. He says, the bank has offered me a life insurance cover with the home loan I had applied for. Should I opt for it?
I think it'll be much lower cost if you opted in for a pure term insurance cover. Most of such covers offered by banks are higher cost, and also they are decreasing. See, the bank is interested in having a term cover just in case the most unfortunate thing happens to the individual who has the home loan. Then the bank can recover the cost. However, if you have a term cover, the bank can recover its cost, and whatever is left over can also come to the family. And a term cover is almost always going to be cheaper than taking this, what they call the home protector or the home insurance. It's not a home insurance, it's like a home life protector. So I would advise, please go for a term insurance cover. It'll be much cheaper and it won't reduce. So if anything unfortunate were to happen, there'll be something left over for the family as well.
Right, we've got Varun from New Delhi. He says, I purchased a flat of approximately 40 lakhs and he wants to understand about a good property insurance plan for him.
So there are 2 kinds of home insurances, and you need to be very clear about which one you require. One protects the building, the structure from any floods, from any damage, from any fire, from any malicious breakdown, etc. And the second protects the contents. Now the contents are all your television, electrical goods, refrigerator, computers, even jewelry up to a certain amount. So all of that comes under household goods protection, and the home protection or the buildings protection is essentially for the construction. So you need to first determine what you want to cover, and then there are lots of options. Most of the general insurance companies have a very good option for home insurance, and I definitely advise you to take a home insurance because it's a very expensive part of your life, and if something were to happen to it, it's just going to go away, unless the government does something and kind of pays you back in some way, which is fairly unlikely.
Right. Well, we've got a phoner. We've got Manpreet on the line. Go ahead, Manpreet.
Hi, I'm 32-year, non-smoker, married, NRI, and looking for two-term insurance policy for 1 crore each for 27 years. Which policy can I buy being an NRI?
Right.
So every term policy cannot be bought by non-residents, but some can. So you need to declare if you are a non-resident. I believe ICICI, Future Generali, and one more are available, Max, are available to NRIs. Because otherwise, the first question they ask you is, are you a resident Indian? And if you're not, they would not offer the particular plan to you. And once you've kind of declared that, then if you buy the term cover, you are covered. You would need to have a certain amount of income to get 2 plans. And when you buy these 2 plans, kindly declare to each one of them that you're buying the other one, because you're buying them almost simultaneously in a decisive way. Actually, there's no particular reason why you should buy 2. You could just go for a single plan of 2 crore rupees rather than 1 crore, 2 plans of 1 crore each. But if that makes you more comfortable, please go ahead with that. In terms of premiums, given your age, and unless something is medically different from normal, as long as the condition is normal, I believe your cost should come to for a 1 crore plan should come to about 13,000-14,000 rupees. You'll have lots of options out there, and you certainly must explore them, and you will get a cover up to 30 years as well.
Right, we've got Naresh from Cuttack, and he says, I paid 5 premiums for my ICICI Prudential Life Stage show policy. It started in 2009, and he says, I've paid rupees 40,000 each year, totaling to 2 lakhs. I'm not planning to invest any further. He says, since my policy document states the policy will be paid up after 5 years, I want to understand, should I stay invested or should I exit?
I think you should certainly stay invested. Most of the unit-linked products since before 2010 had high costs. I must also clarify, after 2010, ULIPs have become really low-cost products and very consumer-friendly products. But that has also implied distribution margins coming down, and what that has meant is not many distributors are very comfortable distributing these products, and hence the total volume of these products has come down. So please stay invested. Now that you have incurred the initial expenses, from here onward, it's a very low-cost product, and you should definitely not think of exiting. You could, if your policy demands you to make further payments, you could convert it into, and you don't feel like making any further payments, you could convert it into a paid up policy, which would imply it will be a proportional policy in terms of proportional benefit. So if it's a 10-year policy and you've paid for 5 years, you'll get half the benefit that you were supposed to get. And that will not be a bad outcome. But I think cancelling the policy will not be a good idea. You would have incurred the costs, and you will not get the long-term benefits that you're supposed to get from such policies.
Right, Yashish. Now, that's all the time that we have on this show, but you can write to us at ask.policybazaar.com. You can tweet us at policybazaar_in, and we'll see you next time. Goodbye.